And welcome to another edition of the Money Mindset Podcast presented by Park Bank. My name is Rob Chappell. I'm the executive editor of Madison 365. Joining me today, the co-host of the 365 Amplified Podcast, Stephanie Díaz de León. How you doing?
Good. How are you?
Doing great. Thanks. Also with us, the first vice president of branch banking here at Park Bank, Suzanne Johnson. How you doing?
Hi, I'm doing excellent. Thank you.
All right. And also with us, first vice president of business development at Park Bank, Jeff Mack. How you doing, sir?
I'm doing good. Thanks, man.
All right.
Now let's go ahead and move into our first topic. Because you know what? Like the last one, we're going to go in 8 different directions because that's just who we are.
Yep.
Right.
Let's talk about credit. Y'all, I will tell you that credit was something that I was always afraid to talk about. It took me a while to get comfortable. Like money, I feel like I could talk about, but credit felt imaginary to me, like something that it wasn't real. What was your first conversation about credit? Like, how old were you? And what was it around? Like, mine first was maybe 20. And I was applying for my first apartment. And that's when it dawned on me, like, oh, I needed credit, right? And I had no concept of what that was and had to have a conversation with a friend of mine to talk to me about it. But what was all of your first conversation around credit?
I know mine. I remember. Mm-hmm. So mine was my dad. He just told me, don't get no credit. You don't want to owe nobody. So that was my first initial conversation on credit. Was like, all right, I don't need no credit. Pay everything with cash. Mm-hmm. As I said last week, I still carry cash. But he was like, pay everything with cash because you don't want to owe nobody anything. Mm-hmm. You don't want to owe anyone anything. Sorry. And then my actual when I first got the idea that it was important to have credit was actually my girlfriend at the time, now wife, in college. She was like, well, I had a scooter in college. Sure. And so she was like, well, you should just get a small credit card and just put the gas on it so that you can build your credit. Yep. And I was like, all right. And that was the impetus for me having credit, or probably getting a credit card. And then it was interesting because then I had a buddy who would use that credit card to get flights. Mm. And so now I was building credit that way. And he paid me some cash because he hadn't got a credit card. And I was telling him that he should get one, and then he didn't. But there's different strokes or different situation. But so that was how my credit maturation process all started. My dad told me, which I thought was a good principle. Yeah. Right. Like I do believe there's a fundamental principle that needs to be addressed and needs to be communicated with all people. It's like you really don't want to
rely on that.
You don't want to rely on credit. You don't want to have to borrow money to do the things you want to do. And then sometimes if you're borrowing money to do something that you don't have the money to pay for, you probably don't need to do it yet. So, but then there was this maturation process that happened where there was some different pathways, different trajectories that I wanted to go, wanted to buy a house, so on and so forth. And so I needed to be able to have a credit score, which would help the determining factors for if I could buy a house or not. And that was a good starting point that my now wife had kind of led me on the path of. So that's mine. Yeah.
Mine was, so my mom, single mom, 5 kids growing up, and it was always her focus to buy a home and to purchase a home. And so I remember her working really, like I didn't understand it all at the time as I was like, I would say probably middle school or so. And I remember her working really hard with her bank, as well as the person that was helping her buy her home. And she was monitoring her credit. She was focusing on her income, like everything. Like we knew that she was trying to get to this goal of purchasing her home. So that's like my early on memory with credit. She did eventually do it, actually. Like
I was going to ask, did she get?
When she did it, she surprised. Like we knew, like for over a year or so, that she was working on like her credit, income, all that stuff. And then she said she was just taking us to the house to look at it. And she had actually had a house. So that was that's a memory
awesome.
that I have about just finances and credit and seeing her work really, really hard to achieve that goal. So I would say that's one of my first.
That's awesome. Yeah, it's a great memory.
I don't think I ever had a serious conversation about credit until I was trying to buy a house in like mid-20s. And it was sort of dot-com bubble time, like late 90s housing bubble, and they were giving loans to everybody, and they probably shouldn't have given one to me, but they did, and it was all right, and I made it. But I don't think I had a serious conversation about credit before that, which I think is probably not great.
Yeah. No, I was just really interested to hear how people learn or experience credit for the first time in such an. Mine was very similar to Jeff's. Like my earliest one was like, don't depend on credit. Always have cash. Like because my family had bad experiences with credit and such like that, and not really understanding it. So I think this is an important concept. I think it's an important thing for all of us to talk about and have a conversation about. So where did the concept of credit scores come from, and when? Oh. Yeah, I like the rock, paper, scissors.
Because I'm not great with dates, but I wrote down just some notes. It was in the 1950s to like standardize how credit is given. More so because more people needed to lend and financials needed a way to like make decisions.
I mean, the premise is really more like if you can pay on the small things, if you can pay on your credit card, you can pay on your car note, you can pay on your student loan. You should be able to pay on a much larger. You develop a track record that says that, we see that you've been able to do this. You should be able to handle your largest investment, a house or something to that effect, right? And I think for all intents and purposes, it's a good way to gauge credit worthiness and really just mean your ability to repay. I think there are some historical issues and problems but that's with anything, right? Anything that was built in the 1950s probably has some
any of our systems
has some issues that like maybe lean a certain way, versus other ways, right? But I also think too, if you have good credit, you normally understand how to budget. You understand your finances, what you can afford, what you can't afford. But people make mistakes all the time. And credit can be a huge inhibitor to goals and initiatives you're trying to accomplish. And it can also be really amazing stepping stones and opportunities. So.
Yeah, I think credit is so complex because you can do a lot of work on your credit, and it just depends on the goal too, because there's so many things that go into it. But just going back to what Jeff said, the way that I talk to kids about it, it's like your transcript. Like how you did.
What a great way to explain that. It's the transcript. It's a great way to make it age appropriate because that's what they understand. Absolutely.
And it's what the colleges are going to look at when they're admitting you into college. They're going to look at how well did you do in your classes. Yeah. So it's kind of like your transcript for building your credit too. And then one of the challenges is getting credit to build credit too. You have to have credit.
To have,
But there are ways to do that.
You said a lot of factors go into the credit score. Can you kind of talk through what those factors are?
Yeah, number one is your payment history. So that's 35%. That goes into that. That is something I definitely learned very young on. Don't pay anything late.
Yep.
Your utilization. So this is one that I think is not talked about enough. So based off your credit cards, how much of that are you using? So let's say you get your first credit card and it's $1,000 and I'm really excited and I'm making my payments on time, but I'm maxed at $1,000. That's 30% of your score. So
that's a negative if you've...
Can be, so it's telling the creditor, okay, you have this access, but you're using it all the way up to its limit. So what are the chances that, if you were to miss, you're like right on the cusp of potentially not being able to handle.
Right.
Yeah. Or nobody can handle more.
Yes, and then show that you can be responsible with how much you have, which is usually around 30%. They'll look at your utilization. So if you have 1,000, you want to keep it no more than like 300 on that. It's going to help better than I have 1,000. I'm making all my payments on time. Why is my credit here? It's because you're maxed at 1,000.
Got it.
And it's a big chunk of your credit.
And then there's the other piece, and I'm thinking about it from when you are looking to access credit. There's who is looking at your credit at that time? How many times your credit been pulled? I mean, we all have. I think we get one free credit report annually through all three. So there's 3 credit bureaus, right? So there's Experian, Equifax, and TransUnion. Those are the 3 main sources. And then when you are looking to access credit, someone pulls your credit. There could be a tendency where you're trying to do the right thing, which is you're trying to get multiple offers or multiple options and get quotes from different individuals. Where at that moment in time, sometimes, where if they're all coming for one, if you're trying to get a house and you're seeing banks, all banks or credit unions requesting credit, that is okay in a certain time frame. But let's say if you're applying for a house loan, you're applying for a new credit card at a retail shop, you are trying to restructure your student loan debt. You have a car note that you're trying to refinance. When you're trying to do a ton of things at one time, it can kind of throw off the numbers, and sometimes that can affect, because too many. I can't remember what the proper phrasing is, but it says something to the fact of like too many inquiries at this moment in time, right? Because that seems like, why are not, kind of to Suzanne's point, why are you trying to access so much credit right now? What's happening? Yeah. And that normally is like someone's in peril, someone's trying to restructure stuff because they're
short on something.
Yeah. And so again, it's when you're trying to find something specifically, buying a car, buying a home, and you are looking at those institutions, those lending institutions that are in that particular lane or field of accessing or providing you money, that is okay. But when you're doing multiple things at one time, it can sometimes throw you off. It's not a huge inhibitor or not a huge knock on your credit, but it is something that if you are on the cusp, it can kind of
reflect on it.
Yeah. It's 10% is what
10%.
10% of the credit that it impacts. And that's like the increase, the pulling. You said cars, that's what it was. It threw me off. So like planning for how you're going to use your credit is really important. So sometimes you go to a dealership, they might pull your credit 13 times to try to get you to the best offer. So that's 13 inquiries. So versus if you went to your bank, it's like one time. So sometimes we're like that, but the car dealership might be just trying to put it out there to get you the best interest, the best terms on the loan.
Sure.
And so they're going to run it. They do their lending.
So, so there's a trade-off, right? Like, you get 13 times, but you might get a better rate because they're trying to pit people against each other to see who can give you the best rate. On the flip side, the one institution is going to only run it one time, so it won't really affect you, but it's just one option.
Right.
Again, if you have a relationship with your banking institution, you probably already know that like they're going to try and provide you the best possible rate that you can get, and there's a lot of services and terms that go along with that. So that might make more sense for you, but again,
and then you're equipped, right? Like how much you can afford, what the payments will look like, so that you're more controlling the situation.
I was going to say, like, how much better is it, right? Like, what I'm hearing too is like by going in with that information already. Like you could also negotiate maybe a better deal because you're like, I already have the loan. I already know who I'm going with, and they know me, and they already offered me like. So this is my max. This is what I have. This is what I can work. And that's the other thing too, right? Like your home institution typically knows already what your paycheck is deposited every week. So they'll tell you like, hey, based on this information that we can see here, $80,000 for a car is maybe not something for you. Right? Like, like we can see what...
It's not something for a lot of people.
And also, why do you need that much for a car? Like, I mean, I do remember like a really good friend of mine after we had just graduated from college, and he insisted on buying a Hummer, and it was like... I don't know. Like, it was a thing. That was a thing. And, I was like, we should maybe just go to the bank and ask. He's like, no, so I have it over at the card. I'm like, and I very remember, like, he had never walked into the bank before, but we walked in, and I swear to you, the teller was like, let me get you the right person. They started talking about it, like, we know what's in your bank. We can see you can't afford that. Like, we're not even talking insurance yet, right? Like if you go in there without knowing exactly what it is that what's coming in and what's going out, they're going to tell you that you can afford that Hummer. You can't. You can afford the Hyundai, and the Hyundai that is used. That's okay. And that's and you can
from point A to point B.
And you'll get to the Hummer or maybe something else. But I remember like you can't do the Hummer. You can do the Hyundai, the used Hyundai that is reliable for you. That is this money. But it was that concept of like understanding your credit and trusting who you're working with is important because they can really tell you like. This is what you really can afford, and this is what you can't.
And so that your payments.
Yeah.
I mean, you bring up a really good point. Like that's, it's. I mean, a lot of times when you look at money, you look at network, you look at connections, you look at everybody knows somebody that might be able to figure out a way to get them a deal. Right? And in the same sense, you need to know somebody who can help you figure out what's best for you. And who you can have that real, live, honest communication with around what is the best use of your money at that time. And a lot of times when you're able to do a pre-approval if it's buying a home or pre-approval for buying a car with your local institution. Like for us, it would be with us, it's sitting down with someone, your banker, your relationship banker, your private banker, whomever, and actually having an honest discussion around what is available and what are the best ways with which to use your credit.
Yeah.
Right. It doesn't need to always just be a straight loan. Maybe it could be. I know we're talking about credit, but think about credit from another stance of like there's different ways to or different products from a credit standpoint. Right. It could just be a loan. It could be a line of credit. It could be it could be what's the one where it's secured by cash, like a cash secured, secure card. It could be your credit card, right? It's just having a discussion around what is best, what's the best use, or which credit opportunity or option is the best use for you,
and before you need it,
right? Yeah,
I feel like if you could think of credit before you need it, and then you're sitting down with someone, like especially if it's for a home, like. Maybe not the best time is at the time you're going to purchase a home.
Right. Because emotions involved. Like,
when you've already found the house, it's already $1 million. That's all that is.
You have the conversation now. You have someone like Jeff, looking over, like, hey, what can we do? What does it look like? Now you have a plan moving forward. So by that time that you are ready for that home, you're able to get it.
Yeah. And also when you're like, and you look at the houses that you can afford, right? Like you can, like, I have my limit. Realtor, do not take me to over here. This is my limit kind of thing, too.
And then you only know what you know, so you can do all this work to try to improve your credit, but then what if it's not in alignment with what you're trying to get at the end of the day? So someone to kind of give you a roadmap to help you get there is important. The other two things, back to that question, what goes in there, 15% is the length of credit history. Okay. So instead of, like, if you had a card for a long time, you can have it, but sometimes closing those doesn't always help the length, because it's going to average the length of the cards that you've had. And then the types of credit. So having a mixture. If you have a credit card, you have a loan, all those things help.
So just be like, a longer credit history is better in terms of the score. And
a longer good credit history.
Very good point. Very good clarification.
Don't be bogus for 5 years.
Can't make it.
Now that hits your length. So it's like kind of that calculation there.
If you mentioned, Jeff, people make mistakes, right? So what if you find yourself in your 30s with a lower credit score? What are the steps you can take to start to work at it? Like you said, your mom did, like just really working on building good credit. How do you do that?
I think there's so many things that you can do. I think understanding the impact of a mispayment is like 7 years. Like, I believe that it will stay on your credit. So if you need it to call, I think it's important to work with your lender versus like ignoring it to see if there are options out there for those payments. Sorry, Rob, what was the question again?
If you've already got kind of a lower credit score than you want, how can you repair it?
I think you have to know what's on there. So, like, do you have delinquent accounts on there, and how many? Or is it your utilization is up, so you just need to pay your card down? So it's very personalized based off the individual. And so I would say the best way to start is to look at your credit. Like, if you are just choosing not to look at it, probably not great.
Yeah.
I'm just saying, it's hard when our credit's not good. It's like, I don't want to look at it. I'll just keep looking away. But it impacts so many things that impact our quality of life, even renting. So, like, looking at your credit, no matter where you are, make that commitment to just look at it. And then you can do small things to start to impact your credit. So maybe you have 7 delinquent accounts. Maybe you agree to pay off 3. Maybe your utilization is like 50%. I'm going to get it down to 30. And so there's many things that you can do, but you have to be willing to look at it. And we talked about earlier, is if you have a relationship with your banker, like we do at Park Bank, you can come in. We do have credit sense here. So we can look at your credit with you, and to know that someone's there to support you. Like, we help clients no matter where they are, whether they're looking to buy their home, their business, or improve their credit, and then be able to look at what are some reasonable things that you can do to impact your credit. So I think it's starting by monitoring your credit to see what's on there.
Like, look it up.
I couldn't have said it better. I mean, I think what Suzanne is speaking to is, you have to know where you are first, right? I mean, that was something I used to talk about often with clients, was just the first step is just knowing where you're at.
Mm-hmm.
If you know where you're at, like now you know where you can go.
Mm-hmm.
Yes.
If you know you're at this low level,
Mm-hmm.
then you know, like, hey, I can do this to get myself
Yes.
up a notch. And I think too, this is interesting. This would be a conversation I think we could talk about. Was just around what is the proper way. So the proper way, what is the proper way with which to, if you're in debt, how do you pay off debt, right?
Oh, sure, yeah.
So there used to be, the model is like, all right, if I got 3 credit cards, let's just make it simple. If I have 3 credit cards and I have $10,000 on it, I have $5,000 on one, and I have $1,000 on the next one, right? Like, which one do I pay off? Which one do I start to try and pay off first, right? And then there's some ways that people look at it from the standpoint of how much is on it, because hey, if I get 1,000, that's a small amount. I can knock that out. I can feel good about taking that step forward. Now I only have 2 credit cards to pay for. The other way of it, or the other methodology, is whichever has the highest credit or has the highest interest rate. You want to knock that one out first, because that one is accumulating the highest amount of interest, right? And so if that's the $5,000 credit card, you really attack that first, and then go to the other 2 after, right? The second highest and third. And I just wanted, do you have any, Suzanne, do you know, is there any specific, or what's the proper
formula,
way to do it, or formula?
I think it's still personalized. It's based on, it's so many components. Like if someone's trying to improve their credit, that can mean something different to everyone. It could also be time. Maybe there was a late payment and now it's on there for however long. It could be an increase. I got a bunch of inquiries. It'll show the expiration dates for those to fall off. So I think it's very unique to the individual. It's hard to say this is the exact steps.
Which is why that credit sense service is so important, right?
Yes.
That we can't tell you on this podcast what the strategy is going to be for you, but Park Bank can.
Yes.
Right?
That is, Rob, you raised a good point. That is one of the biggest issues. Is when you try and do these credit literacy courses or financial literacy courses, everybody is coming from such a different space and time in their credit, credit history. It's hard to speak in generalities around what credit is and what it's about and how you can help yourself or how it can benefit you, so on and so forth. Because we have friends, or we have people that we know that parents have put credit in their name when they were kids for the positive and for the negative, right? You see an 18-year-old with a 780 credit score. You're like, I don't know how this happened. Like, you never had a job, right? They were assigned on their mom's credit card that they didn't have access to, right? To the point of, on the flip side, where somebody's 19 and has a 300 credit score, and how that happened. Mom was just trying to move some stuff, or mom or dad or family or guy, whoever was trying to move stuff around. So, the goal is trying to get into a one-on-one or a relationship basis with someone to be able to have that open dialogue, a real honest conversation on where are we at, where can we go. And I think Park has a lot of awesome tools that we can sit down with and really kind of get into the meat and potatoes of how to move forward.
And also, just also talk to people about goals. Like, what is your goal, right? Because I think you bring up a good point. Like, there's different ways to do this, but what is your overall, underlying goal? And have you thought about it yet? Because that's sort of the other thing that I think is important. I think we talked about it that last week. Is about your individual responsibility in this. And I think Suzanne, you brought up a really good point of just look at your credit. That's first step. And also, what is your goal? Understanding and before you look at a house or a car, what's the goal here too? What are you trying to do with your credit so that somebody can, within your financial institution, can sit with you and help you figure that out and have that conversation with you.
Right. Because improving credit could be establishing credit, which is a different conversation.
Absolutely.
Delinquent accounts. So that's where it's hard to say, do these things. But I think understand what goes into credit. Look at your credit. And then there's tips Credit Sense will give you tips on what you can do or what's impacting your score, and it grades each piece. So payment history, it'll grade you A, B, C, D. Your, I don't know if it's D, but A, B, C. I don't know the exact, but your utilization, and so it'll tell you what that looks like for each one to just better equip you with the knowledge for your credit. And then to your point, to your goals, it could be I want to get my credit here to buy a home, but there's a lot of other things that go into buying a home, your income, your debt to income. So you can have a great credit score and still have other things that you have to improve for credit.
Maybe something pay off something, right? Pay off something so you have more disposable income to be able to move or be be able to allocate toward the home payment,
Right.
So then sometimes it's like you could have a great credit score, but now you have to knock out a couple of things fully, and now do you have the capacity to do that along with also having a down payment and all those things. So that's why it's not
simple.
It's not as simple as like, oh, just get a good credit score. I think we'd be remiss to make it that simple, make it that easy. That's a good baseline to have. Like I just want to have a quality. I want to have a solid credit score. The solid credit score is normally, it used to be 700 above. I think I don't know anymore. It's like for a housing, it's like 680 or it's like 720. But you can buy a house if you have a 620 credit score. But then there's some programs and products that allow you to have lower than that. But again, the goal is like it always used to be a 700 and up credit score was like if you're in the 700s, you have access to credit. It just might be now that's one piece of the puzzle. Now the next piece goes into like, all right, well, how much disposable income do you have to be able to support whatever payment that you're looking to make? So,
is there an optimal debt to income ratio?
Yes. So for housing, and this is on anything. This is on rental property. If you're renting, this is on buying a home. You normally want your housing debt to be 30% of your gross income. So if you make $10,000 a month, you want your housing debt more than $3,000. I just use that number because it's easy math.
Yeah.
I was like, wow, what house are we?
I'm not sitting here saying everybody's making $120,000 a year, so that's not what I'm saying. But just for math purposes, that's where you want to be, because what the traditional idea behind debt was that you really want for total debt to income, you want to be somewhere around 40%. So you're thinking that 10% of your debt should go to what we call consumer debt, car payments, credit cards, student loans, so on and so forth. So, and then what banks normally allow for or can go up to is about 45%, sometimes higher if you have a really good credit score. But the main thing is you want to be around 30% for housing, and then overall 40%. That's where you want to be. And if you can think about it that way. So we used to call it the 30% rule. Yeah. So when you think about your credit card, going back to Suzanne's point, right? On your credit card, you only want to use 30% of the credit limit, right? And that's why sometimes it's really good to kind of push for a higher credit limit. But if you have the resolve and you have the ability to not push it to the limits, right? The goal is you could have a credit card, whatever the interest rate is, as long as you just pay it off every month, you never have to worry about the interest rate. But not everybody has that ability, has that privilege. Sometimes people have to use credit and have to pay interest just because life happens, right? So, so to answer your question, 30% housing and 45% for total debt to income, gross income. So does everybody know what? Yeah, does everybody know what gross? I mean, not y'all, but gross income is what your salary is or what you get paid hourly and multiplied by the hours. That is your gross income. And then your net income is, it's the gross minus any taxes.
Whatever you take home.
Whatever you take home, actually put in your bank account is your net.
What else do you have to say about credit? Anything?
So I feel like we only hit on two of the items. So there's this saying it's the 5 C's of credit. So not to be educationally, but I think it's helpful to understand because again, sometimes we're just taught get a good credit score, but then we don't realize everything else is being factored into it. So it's character, your credit history and your ability to repay your debts. It's the capacity, which is what Jeff is saying. That's the debt to income. Are you able to afford what you currently have, going back to that 30% capital, your savings, your assets, and how much are you maybe putting down on what you're purchasing? Your collateral, so is what's the loan secured by? There's either unsecured, which is nothing, it's just secured based off your history. And then there's secured, which is I'm going to put my car up for collateral, my home. And then if there's, the other one is conditions. So if there's certain economic factors that might be impacting them.
So, that's something, if I were listening to this and young and wanting to learn, those are the 5 points that you really want to focus on. And when you think about collateral, the reason why collateral is so important because it's a huge determinant to what the interest rate will be. So when you have something that is collateralized, that means that if something were to go wrong, your lender can take that thing back.
Oh, sure.
Right? Yeah. So it protects their loan that they're giving. When it's unsecured, it's going off of, it's just you.
It's trust, right?
It's just trust, right?
Trust
They're
based on
just
the
trusting that you're
info
going
they
to
got.
do the right thing.
I don't know if I trust y'all.
But that is, and like, this is the world that we live in is a world of opportunity cost, right? And so like, it's just, I could give that money, the bank, say if I'm the bank, right? I could give that money to somebody that I could collateralize it by, which I would be it'd be a safer bet for me, or a safer loan for me. So I will do it at a lower interest rate. But if I'm giving this money to somebody that it's uncollateralized and it's just they're just the whim of them being them, I'm going to get a higher interest rate for that. Yeah. So just be prepared for when you are getting. So that's why credit cards have such a high interest rate, right? Right. Because it's just off of who you are as a person, and they don't know you. They don't have sometimes when you're trying to establish credit, they don't know anything about you. So they're just like, hey, all right, worst come to worst, we'll charge you 30%, and you got to pay that back. Yeah. And so when you think about collateral, I want to make sure everyone thinks about it from the standpoint of like, it's all just you, and they don't know you. It's not, they don't have something against you. They just don't know who you are.
They don't know you that close. Like we do. We say each other Christmas cards. We're not taking
selfies.
About you, right? Like we're not close.
Right? But when it's collateralized and when you get a better interest rate, it's because they still don't know you. They just know that they can take this from you. Right. Like they own this, right? They know.
Yeah. Like if you don't pay it, that's cool. That's mine.
I'm taking it back, right? And so, I mean, I think it's just a very
it's an important distinction, though.
Yeah, what I always want to try and do, and this might be the banker in me, is I want to take the the personalization out of it. Like I think sometimes we take it personal, like
it hurts my feelings.
they're taking this high, they're giving us this high rate because of X, Y, and Z, and that is not the case. It's normally based off of very basic guidelines, rules, regulations that we have to abide by. Or it's just a sound business practice, right? So I just want to make sure that was clear. But those 5, and again, I want to make sure it's collateral, character, so who you are, capacity, what you have available, capital, just kind of what you look like from a financial perspective overall. Do you have cash? Do you have a savings? Do you have 401k? Do you have a job? So those type of things. Collateral, which we just spoke of, and then conditions, right? The last one, and that's when you think about conditions, economic conditions, you're thinking more like COVID, when kind of the world kind of was put on a standstill, and then maybe there wasn't a lot of lending at that point in time, just because we had to figure out where the world was going.
Yeah, right, right. That makes sense. All right, thanks, folks. This is a terrific conversation. We're going to take a break, and we'll be right back right after this. The Money Mindset Podcast is presented by Park Bank. You may not know this. In fact, I didn't know it until recently. Park Bank gets its name from the street where it started back in 1966. That's right, it's Park Street, right on Madison's south side. Park Bank is rooted in this community and has kept that focus and commitment as it's grown across Dane County. That means it's not just a place to put your money or to take out a loan. The people at Park Bank are your neighbors. They care about this community as much as you do, and they care about you too. They'll help you identify your financial goals and help you every step of the way to achieve those goals. Connect with your local community bank today. Stop by any branch, call 608-278-2801, or visit parkbank.com. And we're back, and we're going to finish up with a segment we're calling Math Isn't Mathing. The Math That's Not Mathing today is about our television consumption.
Our streaming consumption?
Our streaming service consumption. There was a time when we all were cutting the cord, the cable, to save money. Uh-huh. I'm not sure that's mathing anymore. What streaming services do we all subscribe to? And are we saving any money by not having cable?
And does it play on our phones?
Is it only streaming, though? Is it apps?
Is it app? Yeah.
Yeah. What do we pay
apps
for?
and streaming?
Streaming is just like your TV platforms, right?
Right. Okay.
But if
so like Peacock is not an app, but isn't it streaming? It's streaming.
It's
okay.
streaming.
Yeah.
That's like
so what's just an app?
App, like if you had like Duolingo, like you can.
Oh, like an app, just like an app.
Yeah.
Oh, okay.
There's like health ones. There's a whole bunch of.
Got it. I see what you're saying.
Spotify, Apple Music.
Yep.
Oh, okay. Bet.
All right.
Gosh, there's so many more.
So many more. I'm thinking specifically about what we were supposed to get to replace cable.
Okay.
Right?
Good idea.
So Netflix was the first one, right? Back when it was like $5 a month. It's much more than that now. And then everybody started adding on. So like we got Disney Plus, and we got Hulu, and we got ESPN Plus,
how
which
many
is the bundle
sports
now.
channels do you have?
Well, I have several that aren't specifically sports, but that I get for the sports. Peacock is Premier League soccer.
Is Peacock still free? It used to be.
There's a free version,
okay.
but it doesn't have soccer. So I pay for the soccer.
On like
Premier
3
League.
different platforms, though.
Well, I have ESPN Plus for USL, which is Forward Madison. And then I have Paramount Plus for Champions League and women's soccer.
Which I don't even know that we have Paramount Plus.
We do.
Because nobody
We do.
uses it.
Well, I do.
Because only one person.
And Peacock for English Premier League.
So how many do you have?
3 that are...
Don't you use the Hulu?
Well, Hulu and Disney Plus and ESPN Plus are bundles.
Oh, okay, maybe.
So we do watch Hulu, but there's no sports on Hulu.
Oh, okay.
And we used to have YouTube TV for live TV, which is basically
that's
cable. And then I realized that was...
Did you just do the commercial?
But then I realized that we were paying for that only for like 3 soccer games a year, so we ditched that. But what else? We did Netflix. We do.
I think it's enough.
I think it's about it. I think it's about all of them. Max. We have Max.
Oh yeah, that'd be
So the point is the way this. So what do you guys have?
I think we just have Netflix now. I did do the Disney when I got it free with my phone for 2 years.
This is why you get an Apple phone.
And we had YouTube TV, but it was shared through our older son. I don't think we do that anymore. I think we just have Netflix, and then we use the free ones. I don't even have time to watch TV anymore. I don't. Maybe there's a sports one that I don't know that maybe we have, but
I don't know what I have. I think we got a pretty decent amount of it. And we got cable.
And you got cable?
And I got a landline.
No, we got rid of our cable.
And a landline?
And a landline. I got a landline.
Oh.
And a phone.
And an Android?
And an Android.
Oh. Isn't that what
So
the
I mean,
landline
I
is?
can tell you.
I know.
I can tell you.
Is it a rotary phone? Does she?
Sneak dissing ain't gonna tell you, man. What I would say is, I think you have to, if you cut the cord, you have to be okay with, like the new. My issue at my house is, once you cut the cord, the access of like trying to find things is even more hard, or more arduous. Like now, it's like, all right, I used to watch this show and this show. My wife loves SVU, whatever, Law and Order, whatever, right? So now all Law and Order now used to be on USA. Did USA have a network? But now it's on Disney Plus. Yeah. So now so now you got to make sure you have Disney Plus. But if that, like, we like Bel Air, but you got to have Peacock
for Bel Air.
Bel Air.
That's a great show.
But then like we like The Bear, so you got to have Hulu for that. You know, so it's just.
It's not my fault that you all have it in every other direction, but in one.
So we do have that.
Prime. Oh, yeah, Prime.
Yeah,
Amazon. Right.
That's right.
Right, which you can rent shows, right? Right. So it's just like this balance, and I think it's gotten so crazy where everybody's doing it. Well, now it almost feels like this is like how the world works, right? It's almost cyclical. Like you might as well just go back to having cable.
Yeah. What's going to happen is all these streaming services are going to get bundled back, and it's going to be just like cable.
This is what it is, right? Like so to me, I can watch all those shows if I have cable. And I just have one bill I got to pay.
Right.
It's just easier.
It's like the circle of life. Like Fawcett just
well, not only that, but like that's how you don't realize how much you have because it's like it's $5 here and $7. I don't know actually how much it is. It's like $10.
And then it keep going up.
Yep.
Right. So
and you keep paying for
up.
one show. Though, like because when you said The Bear, I'm like, oh, that's right. I only watch Hulu for The Bear.
Right.
Like I don't really watch it for any. Like I don't. Need it for anything else. I'm like, I'm paying for one show.
But then are you all of the same ilk that like now you got to start watching the shows more? What else is on there just so that you can get the bang for your buck?
No, I don't got time.
That's where I don't.
See, like we have Apple TV.
Oh yeah,
which is crazy. Which is a cost.
Yeah.
Which I never understand. Like if they got Apple phones, like shouldn't I get it?
Don't I get it for free?
Don't I get it for free because I got the Apple phone?
I think it's like a couple months though, and then it like
You have to cancel before.
yeah.
Or it'd be like that's what would happen sometimes. I mean, we tried to do that, but we just weren't good at it. You could like, well, we'll just get the free trial for 30 months.
Set a calendar.
And you got to set a calendar. You got to watch it. You know? So anyway, I think it's cyclical. It's coming back to the thought process. Well, why wouldn't I just get cable and I can get all of it?
Yeah.
But I think the problem is you don't get
convenience, maybe like time wise.
I mean, that was my thing. So my wife was just more like, look, we can cut the cord on cable, but you just got to tell me where I can find these 8 shows.
Yep.
As long as I got these 8 shows, like cool, just put it on my side of the bed. You have to turn on this, go this one, click on this one.
You gotta make it happen. Though.
Yeah,
like, I'm not
I don't want to be out here like trying to search.
You have to find it for me.
Which and then so anyway, so I think in a very busy life, which I think everybody will say they have, I think sometimes simplicity is better. But I also think if you're trying to save, again, it all falls on you.
Yep.
So do you need all those shows? Probably not. So, I mean, could you get away with X, Y, and Z? And this goes back to the question last week around like,
do you need that free shipping? Do you need that bad?
Yeah. Did you need it? Like, because you only got the bundle because, like, why did I have ESPN? I got ESPN on cable. Why do I have it on my phone now?
Yeah.
You know, I got it because it was a bundle. So,
Right.
I have more music subscriptions than TV.
But you have more music. You have
How many you got?
Like,
you got a Spotify?
I've canceled them now.
Oh.
Like, most of them. But I had, like, at one point, iHeart, Spotify.
yeah.
iHeart. That's a very specific. Like
Right.
iHeart.
Well, I didn't, like, cancel it for a while.
That's like
and
that.
then Tidal, I've tried, like...
Yeah, that's on
thousands.
Tidal.
So that's why you can cancel them. That's how I learned. I canceled them. So I was like, I still have this cancel.
Like I can cancel them. I'm like, oh yeah, you can get all your subscriptions.
So I don't know.
It's dangerous.
Yeah.
I would say, I mean, it all depends on how much TV you watch.
How much soccer do you need, Rob?
And I don't do...
A lot of soccer. I need a lot of soccer.
You do.
I need a lot of soccer in my life.
You're not giving
You watch a whole game of soccer, like straight up?
Strip.
I watch multiple games of soccer.
soccer.
in a day.
Just a whole entire game?
Right now, this is we're taping this in late September. This is the glorious time of year when the American soccer schedule overlaps with the European soccer schedule. So I could be watching soccer from 6:30 in the morning until 10 o'clock at night.
And does he? Yes.
Do you have a favorite team?
Well, Forward Madison, obviously, but in the Premier League, it's Fulham.
Who you got to see?
So, like,
Yeah.
so you could watch a whole day of sports and see like 3 scores. That's wild. Soccer's tough, man. Soccer's tough. I don't mind the World Cup or the big one. But soccer's tough to watch.
That's how I feel about baseball. I can't watch baseball.
Yeah.
And you could. And I was like,
Baseball's tough for me too.
No, I can't.
I like sports in person.
Yeah,
don't
I think it's a
watching it on
different
TV.
experience. Yeah.
Our daughter said the same thing. She said to me, "I don't need a narrator."
Yeah.
She wants to go to the game.
Smart.
It's really exciting.
I can watch it.
But on
Yeah.
TV,
I get that.
no.
So maybe we'll cut it.
Maybe.
We won't.
Sounds like you guys will not
He's
be
like,
cutting
yeah,
it.
we
No.
cut that free shipping.
Yeah. I was going to say, like, free shipping or your games. Which one do you want?
All right, folks, this has been the Money Mindset Podcast. Thank you all for being here. See you next week.
Rap.